Hey everybody, Kevin Schwartzel here. I've got TJ on the line with me as well. Want to cover some things about funds. I've been talking about for over a year now how it's been amazing to see the note business go from a niche to its own asset class. And nothing makes that point better than the ability to invest in funds, especially funds like this one, the MWM fund, where it's an A-plus fund where anybody can get involved as long as they have $200. That's right. So you've heard us talk about this before. TJ and Rick started this fund. I came along, was very, very impressed with it and very happy to be a part of it. But there's a lot of different types of funds out there. And if you follow financial news, as many of us do, this came across my desk. And that's why I wanted to get TJ on the video here with us, because across my desk on one of my investment newsletters that I read, they talked about real estate investment trust, which is another type of fund that are going into big trouble already. So I wanted to clarify the difference between different types of funds and what can happen. So TJ, before I turn it over to you here, just to show you what I'm talking about here, of course, this is the MWM fund, but this press release came out, Invesco Mortgage here. They have unusually high number of margin calls. They are in big trouble, a huge fund. Here's another fund. On their press release that just came out. You can see the dates here, everybody. I mean, this is all new information. What happened? Usually high number of margin calls. The next one here, TPG RE Financial Trust. Yet again, a high number of margin calls. Can't find it on this one, but it's in there. And the final one here, whoops, went the wrong way. The MFA fund, once again, unusually high number of margin calls. These big companies, TJ, are in big time trouble. What's the difference between a fund like this and what are margin calls all about versus a fund like the MWM fund?
Well, thanks for thinking of me, Kevin. Yes, this is a huge thing because when times are good, as they have been for 10 to 12 years, REITs have been performing like 482%.
And a REIT, for those who don't know, right? It's just a real estate investment trust, right?
It's a real estate investment trust. And I kind of want to just give a brief overview for those of you out there that don't really know what it is, and I'll keep it really light. So in 1960, the Congress, they passed a law creating real estate investment trusts. REITs is what you'd actually be seeing them in the news. So to give average, and what it does is give average individuals the opportunity to invest in, income producing commercial real estate. Okay, there's private REITs, there's public REITs, and there's something new like an E-REIT, right? That's kind of a hybrid that has come out. But primarily right now, there's over 800 private REITs and over 200 of them are publicly traded REITs, meaning that they move in lockstep with the market, right? So they only make up really a fraction of the 11 to 12 trillion dollars that is in the U.S. commercial real estate market. So now, there's a lot of people, Kevin, that are invested in these. Today, there's an estimated something like 70 million Americans invested in these, and they own shares in these various REITs. Basically, you're investing in a REIT, you're owning a share of a company that when their things are going great, the shares, the dividends are great, everything is going good, their earnings are good, then your shares are up. But once they don't go so good, you own shares in this company, just like a publicly traded company, that money gets vaporized. All right. So really why, REITs have become so popular, it's the exact reason why it also makes them so dangerous is there's been huge, big fat yields that investors, retirees have been looking for at these due to the leverage that they can take advantage of, right? And this segues into, Kevin, when you're saying the margin call.
What the margin call is, right?
And this is basically what it is. And so the business model of a mortgage REIT is simply to buy long-term residential or commercial mortgage-backed securities. And basically, we all know what a mortgage-backed security is. If you don't, it's a bunch of mortgages and they pile them in and they put them into a security and then it's based off of what is in there. A lot of the times they call it a black box because a lot of the times they don't even know what's in these mortgage-backed securities, but there's a lot of loans, right? And what they do is they basically leverage them up by borrowing. What it basically means is they're borrowing short-term including in the repo market, which is a market over there that's like a intraday lending institution between the two. And what they're doing is they're actually posting up the residential mortgage-backed securities and the commercial mortgage-backed securities as collateral for these short-term loans. So simply saying leverage is what? I can buy a $200,000 piece of real estate for $50,000 out of my pocket, right? It's therefore, it's great when times are good, but also bad because, you're going to have to pay the debt service or whatever that loan is that you took out. And if it doesn't cover what you're actually getting in, then you're in trouble. So that's kind of where we're at now. So
what happens then if they own a bunch of notes and they've pledged it essentially as collateral, that's all well and good as things are going up. But if now those loans that they have start to devalue themselves through non-payments, the person who lent them, the company, the entity that lent them the money is going to say, we need some more collateral here. You have to pay up. And that's what the margin call is. And of course, they're so over leveraged, they don't have the money to pay the margin call, right?
You hit it right on the head, man. What happens is they value these things. They're going to value these financiers that gave these REITs all this money. They're going to say, okay, well, we're lending based off the good faith that what you're giving us as collateral is worth an X amount of dollars, right? So when they go back in and value these things, which they just did, the values have dropped so significantly that they're like, okay, we need more money now from you guys. And these guys are over leveraged, let's say, and going, well, we don't have that money. We're just making money off of the spread from the money that you're giving us and the bonds, the mortgage-backed securities, what they're paying. So if they're paying 8% and you're paying 4%, what these REITs make is the 4%, right? So without going, it's really crazy to think about, but that's kind of at a macro level of what's going on. And when you just said it, when there's a margin call, it means, hey guys, we lent you this money. Our exposure right now is way too high. You need to give us some more money. Or the problem that lies right now is they're going to have to take those back, right? So like who's RBS, I believe, was saying to a REIT, well, you guys got to give us all the collateral back because we have to get some of this money back so we can lend out. Lending institutions are about doing one thing, and that's lending money out, making fees off of that. Well, if they're not making any money, they need their money back. And so there's a whole problem now going on with REITs suing these guys, what have you.
Man,
but
and these are multi-billion-dollar funds here, and eventually they're going to have to give up those assets. The lender is going to take those assets back. They're not in that business. They're going to end up trading those, and that's going to be inventory for individual note investors. But tell us about, though, on the MWM fund. This is a type of fund, but it's different than a REIT, and it's not an over-leveraged type of fund. So address that issue for us, if you would, as well.
Absolutely. Biggest thing is that we're not passive, right? We work each whole loan within the fund. We're not talking about just a bulk group of loans within a fund and letting somebody else work that. And then we're working off the yields off of that group like a mortgage-backed security is, right? We are active investors within the fund working each one of these loans. And another thing is that as a publicly traded REIT, which we are not, you rely, like I was saying earlier, they walk lockstep with the market volatility, right? So the problem is that when the market goes down, your shares go down in that REIT. With MWM Fund, you're owning Class A investor shares, and it's an LLC share. It's giving you the opportunity to participate in the fund and earn profits from the profits that we generate with operating within the fund. Our shares in our business model from the get-go was not for you to be able to buy MWM shares at $10 a share and then ride it up to $50 a share and sell. And that's where you make your money. That's not what it is. This is, I want to be able to participate in MWM Fund, earn up to the returns that we're promising, and that gives you the right to do that. So you're not holding these shares with the intent to sell them and make money on them. Right. So that's where I really want to be clear. That's where we differentiate. You're basically buying LLC shares, right? Within Money with Meaning Fund LLC, that gives you the opportunity to get in the waterfall. right? So that means we're going to pay all of our investors first, then we're going to return their principal, and then us owners, okay, we get, we get what's left over.
Yeah.
And so that's really the most important thing I wanted to differentiate. And I thank you, Kevin, for reaching out, because some people are like, well, you guys invest in mortgage notes and what, the REITs are going down. What's going to happen? Believe me, it's a whole new ball game. I don't even want to go into that world because it's scary.
Yeah, there's going to be a lot of turmoil right now, and it is important to understand the type of investments you're going to get, because you are going to hear negative financial news. Everybody is, for a period of time. It just is what it's going to be. So very important. And it comes down to, you still want to be invested. You still want to take advantage of opportunities that are going to be created from all of this and prepare for that. But you're going to have to make some decisions. So decisions are, make sure you know what type of fund you're getting involved in and what the players are and what they do. So again, MWM fund being very, very different than what a REIT, a commercial real estate REIT based in Wall Street, is doing, and what can happen if things go wrong. Very important for investors to realize today. You had one more comment, I think, TJ. I cut you off. Sorry. No? Sorry about that.
I probably did, but I don't know. Probably.
Didn't mean to cut that off, but I just wanted to summarize that up for everybody.
I know what it was, Kevin. You tapped on it really fast. For all of you note investors out there, or real estate investors out there, whoever that's looking to get into the business, what this is doing is this is going to create a top of the funnel type of inventory supply for everybody. And you touched on it a little bit, Kevin. These mortgage-backed securities, there's going to be whole loans in those, right? If those start going bad, they don't want this. They want to recoup it. So they have to get those out as soon as possible. So what happens is they start to trade those down, and that's where a fund like us can step in. We're just a bigger investor, just like you guys. We just have a little bit, of an ability to raise more money, but we're just like the guy that's buying one or two notes, right? We're going to have that ability to be able to grab these, buy them at a really good discount, right, help the family out, do whatever you need to do, turn that thing, make it better again, and sell it for a profit or hold on to it. So, yeah, I just wanted to touch on that this is exactly kind of what we've been speculating, that this type of thing is going to happen. And we're really, really excited, and we're prepared to be able to take advantage of this.
Well, everybody, it's a great opportunity to learn about investments. You got time. A lot of you have time at home. Learn about the different types of investments to capitalize on the market, because you could be a part of the recovery of this marketplace. The last time the market crashed, the government couldn't fix it. The banks couldn't fix it. Wall Street couldn't fix it. It was entrepreneurs like you and I. Let's prepare for the next wave and make good investment decisions. Know what you're investing in. And by the way, an investment decision to do nothing is still a decision, and probably not the best one. Think about where you can put your money in the best opportunities, and we think we have one here at MWM Fund. So TJ, thank you very much for explaining the difference on that, and hope you all enjoyed that. Look forward to talking to you again.
Stay safe.